everyone, and welcome. My name is Nicola Corzine, and I am the Executive Director of the Nasdaq Entrepreneurial Center. We are so thrilled today to be welcoming you to our session with Wilson Sonsini on venture finance trends. It has been quite a quarter, and we are here to talk about it in great detail today. Now, if this is the first time that you are joining us, we are honored to have you here. If you don't know, the Nasdaq Center is an independent nonprofit who is committed to building a better path for entrepreneurs worldwide because of the incredible work that all of you are doing each and every day. The center, as you may have seen in chat, has built a big commitment over the last few years in mentorship. And probably there's no greater need for mentorship in some regards than around fundraising and financing. So if you haven't yet signed up for the movement, we'd really encourage you to do this. You can find the links in the chat on how to access it. And if you have capacity to give as a mentor in this regard, we'd love to welcome you in as well. This is free, responsive, tactical support to entrepreneurs all over the world as they continue to build bigger and better solutions that are needed now more than ever. We are going to be opening up for live Q&A today. So one quick reminder or intro, if you will. If you have questions as we're going through today's session, please use that Q&A function that you're going to find at the bottom of the screen. Ask questions as we go, and we'll try to get to just as many as we possibly can. None of what we do here at the center, which is all free and responsive, would be possible without our incredible sponsors. So to each and every one of you who believe in the work of the center, thank you. We deeply appreciate and value all of your contributions, your time, your talent, and all that makes this possible. For the last many years, we always start each and every session by slowing down and just asking our entrepreneurs how they're doing. Just when we think we've got the world sort of figured out, things are always changing around us. Now more than ever, it seems that that statement is true. So I'm going to launch a poll really quickly, and I'm just going to ask each of you to honestly share how you're doing in this current moment. We try to make available a lot of wellness programs for our founders, a lot of coaching and support for you. And so this just helps us kind of calibrate how much assistance and support may be needed right now. So thank you for being very transparent and honest with us. The sustainability of you as founders is critical to the work that you're doing. And this just helps us get a pulse as to what is going on with you right now. Good to see a lot of optimism always in the crowd, but understandably some anxiety and some of you that are just working on surviving right now. I'm going to end that poll. I'm going to share the results. Thank you again for that. And at this time, it is my absolute pleasure to welcome back to the house, Craig Sherman, who has been with us for many years now as an incredible talent and knowledge expert in this space. Craig, welcome. It's good to have you back. Thank you for helping us figure out what is going on right now in venture finance. Craig, if you don't know, is an incredible partner at Wilson Sonsini, who is deep in this domain. So Craig, with that, I'm going to invite you to maybe give us a little bit of a lay of the land as to what you're finding right now.
Well, we're going to start out by sharing some statistics. So every quarter, a few weeks after the quarter is over, we aggregate data on the transactions that we're involved with and publish this in what we call an entrepreneur's report. These charts that I'm going to share, 4 charts that I'm going to share, are excerpts from our most recent entrepreneur's report that actually at this point came out a couple months ago. And I think what's really remarkable is and we'll be talking a lot about for the next hour is how much things have changed since the first quarter of 2022. I think everyone's aware of what's been happening in the public markets and the tumult in the public markets that started early in Q1. As is often the case, it takes a while for disruptions in the public markets to spill over to the venture capital market. And so fascinatingly, what you see here are the numbers for Q1 of 2022. So the quarter ended March 31st, 2022. And you will see here that for the second quarter in a row, and only for the second time in the 30 years that we've been tracking venture capital deals, every single transaction we were involved with was an up round. And an up round is a financing where the valuation or the price per share of the round, or the valuation effectively, has increased over the prior round. When we did this session last month and last quarter, and we talked about the data for the fourth quarter of 2021, and I said that was the first time that had ever happened. I said this was a sign of peak market It in fact continued for another quarter, that every single round was an up round, and it was indeed a sign of the peak market. And we of course don't have our data yet for the second quarter, which will end in about 3 weeks, but I can tell you, based on my personal experience and from talking to my partners, that this chart is going to change dramatically. And we are starting to see the beginnings of the down rounds. This is just starting to happen. And again, it's the lag effect, because when private companies are raising money in the venture market, they can delay a financing, so they can delay a decrease in the valuation. And a lot of the companies that are needing to raise money right now didn't necessarily need to raise money a quarter or two ago. The market has been so hot that companies were able to raise extraordinarily large amounts of money, unprecedented amounts of money, at unprecedented high valuations. And we know that we are going to see a dramatic change, but you don't see that change yet in the first quarter numbers for 2022. Cody, why don't we jump to the next slide? So you can see that the one thing that did change in the first quarter is valuations have started coming down. And again, these are not down rounds, but valuations for financings, particularly late stage financings, have really started to decline significantly. The bar that goes the highest on the right side of each time period is the Series C and later financings. And you can see that in the fourth quarter of 2021, for the first time ever, the median pre-money valuation of transactions that we were involved with for late stage companies, Series C and later, exceeded $1 billion. So every single late stage deal that we worked on in the fourth quarter of last year was a unicorn round. And you can see in the first quarter of 2022, that dropped significantly from $1 billion to around $750 million. But that's still a really high number. If you look at the prior periods, it's extraordinary when you compare it even to the third quarter of 2021. It's still the second highest number ever. Similarly, you see the same trend with the Series B financings, where the fourth quarter of 2021 was the peak. Valuations in Series B rounds started coming down in the first quarter quite significantly. And I am certain when we have the final numbers in for the second quarter, or the quarter that we're currently in 2022, we're going to see an ongoing decline. Now, if you look at the earliest stage rounds, the valuations really aren't shifting that much. And that's one of the things we'll talk about later. But I think one of the reasons that the earliest stage rounds are relatively safe for the moment, there's not a lot of room to go down. The valuations of the earliest stage rounds never got as bloated as the valuations of the later stage private companies. Cody, why don't we jump to the next chart? Okay, here we're seeing the median amount of money raised in equity financings. You can see that the amount raised in late stage financings continues to be very high. For the deals that we were involved in, the peak for the late stage rounds was actually the fourth quarter of 2020, where it was 70 million, the median amount raised, and that continued to be high throughout 2021 and continued to be high in 2022. We expect that this number, or I'm certain that this number, is going to be going down in the second quarter of 2022. You can see, interestingly, that for Series B rounds, the median amount raised already started declining significantly. It was 13 million versus 42.5 million in the fourth quarter of 2021. And for the Series A rounds, the minimum amount raised also, or the median amount raised, also started to decline. So we expect companies and investors to both begin to be more conservative in the amount that's being raised. And in part, that's a direct result of the lower valuations. As companies were able to raise money at high valuations, it was easy to take lots of money. The money was available, and there was minimal dilutive impact of raising a large amount of money because valuations were so high. Now that valuations are starting to drop, companies are going to want to take less dilution by raising less money. And let's jump to the last slide, Cody. And so here are the median amounts raised in bridge loans. Bridge loans are financings either before a first priced equity financing or in between priced equity financings. These are convertible notes or safes. They're loans that will convert into the next priced equity round. And you can see that a lot of money is being raised in bridge loans. In the red bar is for bridge financings between priced equity rounds. So it's after a company's raised at least one priced equity round. The gray bar is for the earliest financings before a company has ever raised a priced equity round, a Series Seed or Series A financing. And what's interesting is you can see the amounts being raised in those pre-seed financings going up dramatically in the first quarter of 22, and the number in the fourth quarter of 2021 was also quite high. And our belief is that this is an expectation that companies knew that it was going to be more difficult to raise financings, equity financings, and so companies are properly trying to raise as much cash as they can on an interim basis and delay the fundraising, the priced equity fundraising, as long as they can. So that's kind of a summary of where we are, and we're going to be talking for the rest of this time here about what we expect will be coming.
Such an interesting setup in many ways, and I think a lot of the hypotheses of what we talked about last time, Craig, and to a certain degree, you were right. We got a lot of expectations is what was coming, and here we are. I'm going to try to make sense of it all and look at some of these trends that were on the horizon and are now here in a little bit more detail. And to do that, we have two incredible experts who are joining in this conversation with Craig, incredible investors. I'm honored to welcome SC and Sarah to the conversation. SC is the founding managing partner at Mighty Capital, and Sarah is a growth stage tech investor at Emerson Collective. Welcome, both of you. Would love to invite you to take maybe just a minute or so, share a little bit about your background. SC, maybe we can start with you, and then Sarah would love to turn it over to you.
Yes, thank you so much, Nicola, and the Nasdaq Center team for having me today. It's really a pleasure to be here. So a little bit about me. I founded Mighty Capital 5 years ago. We're going to celebrate our 5-year anniversary in the fall. We invest in Series A companies, mostly in B2B tech. We also do a little bit of health AI and a little bit of fintech. And the value we bring to our portfolio companies is access to a global product platform that reaches over 300,000 product managers. And so if you want to sell your technology to product managers, if you want to be acquired by a chief product officer, or if you're looking to hire product managers, we can be very valuable to you as an investor. And then prior to investing for about a decade, I built products and companies myself for smaller companies of my own, and then for larger companies like Facebook, Electronic Arts, and Siebel Systems.
Amazing. We always talk about the dream state of finding a value-add investor, and SC, your background and also what Mighty Capital is committed to is a fantastic example of what that can look like for entrepreneurs in the portfolio that you have. Sarah, welcome. Would love to invite you to share a little bit about your background too, please.
Thank you. I'm Sarah. I am an investor at Emerson Collective, and we're actually a much broader organization, broadly dedicated to helping people live to their full potential. And one of those aspects is investing across companies and startups. And so venture capital is one aspect of that. The venture team here basically focuses on accelerating growth of companies that are positively impacting the world. And so we primarily invest across sectors such as health tech, fintech, future of work, energy, media, environment, et cetera. And before this, I was actually investing back at Sapphire Ventures, which is a very B2B enterprise SaaS focused venture firm. And prior to that, I was working in investment banking, but so happy to be here now. And thank you for inviting me to speak.
Oh my gosh, Sarah, it's great to have you. And again, for those of you who don't know, Emerson Collective is just an incredible firm that truly is passionate around helping and being beside founders. Both of these firms in a time like we're in right now are the kinds of firms that you really want surrounding you. They're going to help see around corners. And I think most importantly, be there in the hard times as well as the great times. Not that we're going to be all about doom and despondency today, of that I promise. But on that note, maybe I am going to kick it open to everyone to comment. The last couple of months have been a little bit of the Wild West unfolding around us. Craig, maybe you can open it up, broadly speaking. What are you seeing maybe around volume of deals, volume of transactions? You kind of alluded to some of the changes that you're seeing, but you want to take a minute or two and really maybe go into a little bit more detail than we were able to cover just in the slide opening?
Yeah, I mean, I would definitely say that the deal volume is decreasing. We are far less busy now working on transactions than we were just 3 months ago. Deals are taking longer to get done. Diligence is taking longer, particularly in the later stage deals. And yeah, the Series C and later, where I mentioned earlier that the valuations were starting to decline in Q1, valuations are definitely continuing to decline. The amounts being raised are smaller, and it's more painful. And for the first time in a long time, deal terms are getting renegotiated while deals are active, particularly in later stage deals. We were working on one financing about a month ago where the day we were supposed to close, everyone had agreed. It was a large financing, it was around $100 million financing. And one of the investors, the morning we were supposed to close, called up and said, we've been thinking more about this. We like the company, we want to do the deal. I was expecting them to propose a repricing. They actually did not propose reducing the valuation on the deal, although we are seeing that on other deals. What they did do is they asked for a multiple liquidation preference. What that means is, in a typical priced equity financing with a venture capital firm, the investors logically get their money back first. So if the company is sold, the investors get repaid before the founders of the company receive any money. What's changed here is that this investor said, we want to make sure we get a positive return before the founders get anything. And they insisted that they will get double their money back before the founders get anything. And on $100 million financing, of course, that has a huge financial impact, where the investors in the latest round get $200 million back on their $100 million investment, not only before the founders get anything, but even before the earlier investors in the company's Series C and Series A financing receive anything. I had last seen a multiple liquidation preference in 2002, and I thought that this had gone away. That for those of you who have gray hair like me, you may remember the dot-com crash and kind of the nuclear winter that we went through in the early 2000s when the dot-com crash happened and valuations came down and investors were in a position to impose really onerous terms. In 2001, 2002, I saw a number of deals with multiple liquidation preferences. And what ended up happening with a lot of these companies is that employees heard about it and ended up quitting the companies because they felt like, hey, my equity has no value. And if my equity is buried under all this liquidation preference in a declining market, I don't want to stick around in this company. And I'm not talking about just rank and file employees. I'm talking about members of management teams quitting companies back at that time because of these onerous terms. And I hope that we're not going to be seeing more of this, because I think it's counterproductive. That's on the negative side. On the positive side, Nicola, because you said we wanted to talk about good, positive things.
Please, if we can.
There definitely is a lot of early stage activity. The seed financings are very active, and as I mentioned earlier in talking about valuations, the valuations had gone up, meaningfully over the last 5 or 10 years for the earliest stage financings, but not crazy for the median transaction. And so there's not as much room to fall. There's still a lot of capital available in the early stage funds, and these funds are paid to invest. So I think for the earliest stage companies, don't abandon hope. There are investors who want to invest, and there are deals that are getting done.
Oh, there is so much in that. Craig, I was thinking about the Great Resignation and what is that going to mean with all of this? And now you're talking about the impact to, the earlier stage investors like SC and Sarah here. So maybe on that note, both positive and maybe any challenges that you're seeing. SC has the last couple of months going, and I'd love maybe to say within your existing portfolio, how your portfolio company is doing, as well as how's new deal flow looking for you guys.
Yeah, absolutely. And I'm glad you bring that up because it's obviously a really key distinction. So for the company, first of all, what Craig is sharing, we see exactly the same trends. For the companies that are in our portfolio, what's important to us is because we are in that, fortunate place where we're early enough that the valuations don't have that far to fall. We want to make sure that for the ones that are on track to raise Series B or Series C, they're going to make their money last a really long time. So when we do a portfolio review, we look at how much cash is left at current run rate. If we reduce the run rate, like how much cash would we be able to, how much longer could we make the company last? And that's really a lot of the discussion and dialogue we have with entrepreneurs. We're very fortunate that currently in our portfolio, every single one of our companies has enough money to last through the end of the year. Now that may not be enough, like who knows, I'm not pretending to see the future, but that's already great news, which means, we don't have to make hard decisions. And I know some of my colleagues are having to make these about, do we let a company, run its course, because we have to be mindful about how we use our reserve capital to fund some companies, but not all, because there's just not enough capital. So we're, like I said, we're fortunate that we don't have to make these decisions in our portfolio. What we see also, and to Craig's point, right, we haven't seen valuation drops. We have seen tighter liquidation preferences. We have also seen warrants. It's like goes from the past in the last few months. And I think that is partly, a bit of fear in investors that they want to, protect the downside. But it's also partly that entrepreneurs have been used to really high valuations. And there is this myth, I will say, that the higher the valuation, the more valuable the company. That's not the case, right? The valuation is just a number that doesn't mean anything until the very end of the road, until the exit. And so if there's misalignment between what an entrepreneur will think their company is worth and what an investor they think the company is worth, some investors will choose to fight the battle and say, please lower your valuation so that it's fair. We like that. We like very simple terms, but we don't always, win that discussion. And so if the entrepreneur is not willing to be a little bit more realistic, then the terms have to be adjusted accordingly. So it's a bit part of that long-term relationship between investors and entrepreneurs. And then outside of our portfolio, just like Craig was saying, we see deals that take much longer to close, and we see renegotiations halfway through deals. We do see a lot of deals, like we haven't seen less deals than the past year or so, but we see a lot more sort of let's watch how things play out over the next couple of months. So wait and see pattern.
Inevitably, right? The wait and see. Craig, before I flip over to Sarah, just because I think the breadth of audience that are joining us, could you maybe go into a little bit of details of what SC was talking about on the warrant side, where that can often show up in deal terms for entrepreneurs?
Yeah, warrants can, and I've seen this as well, SC, that rather than adjusting the valuation down. So as the public markets have been kind of in free fall and falling, feels like 2 or 3% every day for the last couple of months, the valuations have, one way to adjust the valuation is just to say, we're going to lower the price per share of this round and the valuation is going to be lower. Another way to effectively do the same thing is to say, okay, we're an investor and we've agreed that we're going to invest at this valuation, but you're going to give us not only preferred stock at that price per share, you're also going to give us warrants to purchase additional shares. And those warrants usually are outstanding for 7 or 10 years, and they never really get exercised. It's not about the company being able to raise more capital. Those warrants are really just free upside for the investors. And it's effectively a way of lowering the valuation without lowering the valuation, because there will be more fully diluted shares outstanding. Fully diluted shares meaning outstanding shares, options, outstanding options available, and also warrants that are outstanding. There are more shares on the cap table. It's more dilution to the existing stockholders. So it's a way of lowering the valuation without lowering the valuation.
So helpful. Thank you for setting that. Sarah, similar to SC, you, Emerson Collective, all are about founder first. How do you think about founder first in the last couple of months? How is that showing up for you in the way communications are going again with your portfolio companies, as well as how you're evaluating deals right now in this current climate?
Yeah, I think to echo a lot of what Craig and SC were talking about, I think there's right now a little bit of a disconnect in terms of valuation, just in terms of what investors want and what founders want. And that's tough because I think founders have had months and months of, optimistic raising and investors approaching them with sky high valuations, but that's kind of come down, especially in, I think, Q2 this year, and hasn't been yet reflected in the data that Craig was sharing. And so now I think, especially, I think across a lot of portfolios, not just ours, but just in talking to other people in the community, there's a much more increased focus on shifting to sustainable growth rather than growth at all costs, a focus on profitability. And so I think that's one. And then also on the other front, I would say that deals are still happening for sure, especially for the best companies out there with solid fundamentals. But because of the valuation disconnect, there's been talk of structure. Do you raise debt, convertible notes? And I think actually what we've seen is there's a lot of companies that are actually open to doing extension rounds. So not necessarily a valuation drop, but reopening the last round that they were doing. So, there's a bit of like public facing saving face, and also allowing the investor to get in at a lower price than would have been expected.
That's really helpful. I think that sustainable growth is clearly something that a lot of our entrepreneurs have on the mind right now. How much do I raise and how long do I really need to think about managing through this time period? And like we all say, we don't have the crystal ball. But maybe to both Esty and Sarah, when you're thinking about new deals coming in, what are the current questions or frames that you're asking them to be thinking through when it comes to longevity of the amount of funding that they're raising right now? Do you have sort of the guiding principle of, the 12 months sort of cash in the bank, or are we looking at a slightly different environment? And going off script here a bit, because I think it is such an important question that obviously our entrepreneurs worry a lot about. How much do I raise under the current conditions with the unknown of what 2023 is going to look like? SC, maybe could I invite you to sort of share what your encouragement or thoughts might be as to how to figure that out right now?
Yes, absolutely. I will say we are a bit of a broken record as an investor, because we've had the same message to our entrepreneurs ever since we started Mighty Capital. So we always care about the price we pay when we come into a deal. We look at 3 criteria: the team, the traction, and the terms. So the team, we want to have a great CEO who's really coachable, has hired a great management team. Traction, we want to see revenue growth and defensibility and glowing customer references. And I cannot emphasize that enough. Like, we've had some situations where we get lukewarm customer reference. That's a deal killer for pretty much any entrepreneur. If a customer says like, I've only tried the product a couple of times, or I've only been on the platform for a month or two, we don't know if it's poor judgment on the entrepreneur to give that reference, poor product, poor go-to-market. It's just a red flag all around. And then the third element is terms. And in terms, like I say, we want to see a reasonable valuation, i.e. a reasonable multiple to the revenue. And we want to see a good syndicate of investors. And it's especially true in situations like we are in now, where, you know, when the pie keeps getting bigger, it's not much of a debate, but when the pie has to shrink, sometimes investors will, you know, become adversarial, and that creates really negative dynamics on deals. And so we want to make sure that we come into an investment with other investors that we trust, that will go all the way with us and make the company successful.
Yeah, really, really good sage advice. And I love that you've been doing this forever. So it's not like this is a change in the current moment. This is how it has always been philosophically. Sarah, Emerson, how are you thinking right now about coaching entrepreneurs to think through how much to raise in this current moment and sort of how far they need to go?
Yeah, I would say that obviously there's no absolute rule book in terms of raise 24 months, 36 months, but it's, first of all, evaluating, number one, with your current burn, realistically, if you cut costs, what can you make do with your current runway? And then from there, evaluate, you know, do I need to raise immediately? Is this something that I can wait on? And then if so, am I willing to take these terms? And the other thing to keep in mind, I think, is that survival is better than less favorable terms. Like, even if these aren't necessarily the valuations you're looking for, if this ensures the longevity of your company in the long run, it's going to pay out.
You referenced deal terms, and obviously we heard the somewhat shocking and scary moment of liquidation. Craig, what other deal terms might we get a bit of a glimpse as to what we could expect to perhaps see the next time we bring a group like this together in a few months' time? What else anecdotally may be showing up in the term sheets for our early and our later stage companies right now that you and your colleagues are talking about?
Yeah, I mean, we have been in a period of time since about 2008 where we go back and, you know, the data that I shared earlier goes back only 5 years. If I went back to 2008, it would look very, very much the same for that entire period, other than, as I mentioned, every single round being an up round for 2 consecutive quarters, which was unheard of. But the actual deal terms, you know, have become much more standardized and frankly, very founder friendly, particularly since 2008, even I would say since 2002. And now we're starting to see a little bit of a return to some more investor favorable terms where investors have leverage and they know that they have leverage. So they're asking for things in some deals like redemption rights, you know, the right to demand their money back at a certain point in time, which had really been fading away. And we're starting to see that come in, or investors ask for it more frequently. Dividends, cumulative dividends, meaning that there's a dividend that adds up every year. It's not actually paid out in cash, but it's effectively increasing the liquidation preference. I mentioned earlier multiple liquidation preferences, where in a standard deal in a good market that's founder friendly, the investors have just the right to receive their money back. I mentioned this horrible deal where the investors have the right to receive 2 extra money back. Having a cumulative dividend is a smaller version of the same thing, where it's adding up over time. When the company is eventually sold, there may be an 8% dividend a year that's adding up, that's accumulating over that period of time, that is increasing the liquidation preference that's paid to the investors when the company's sold. So the longer it takes to get the company sold, the more the investors are guaranteed a positive return before the founders receive anything. Anti-dilution protection, we're starting to see investors care more about, where there's more of an adjustment in favor of the investors if the company has to do a subsequent down round. The other thing that we hadn't seen a lot of for years is what's called a pay-to-play provision, which is where the investors, if there's a future round at a down valuation, are punished if they don't invest in a future round. This is actually in some ways company favorable and founder favorable, because it's a way to to force investors who have invested in financings to participate in future financings that may be down rounds. People had just stopped doing it because it just didn't seem necessary, because we've only been seeing up rounds for years and years and years. And now that people are expecting that we may be seeing down rounds for a period of time where valuations are going to be dropping, this is something that founders may want to ask their investors to provide, where the investors are agreeing that if they don't participate in the next round, if it's at a lower valuation, their preferred stock will be converted into common and they lose their liquidation preference. There are a number of flavors of how a pay-to-play can work, but it's general idea that investors in a round are punished if they don't participate in a future round can be really helpful to everybody involved. They can be a little bit controversial because investors sometimes don't want to punish each other. The reality is, as we start the down rounds, and this is what we're starting to see in this quarter, and we expect a lot more of these over the course of the rest of this year, companies effectively do what's called a retroactive pay-to-play, even though there wasn't a provision already in place in the financing documents for the prior financings. Investors will often agree, hey, we're all in this together and we're going to have to invest at a lower valuation, and we're going to figure out a way mechanically to punish the investors who aren't in a position to write a check in this new down round financing. So I will tell you that we are now doing a lot of internal training on down round financings because our lawyers frankly haven't had that much experience doing down round financings since 2008. And we are expecting, and we're already seeing, that there are going to be a lot more down round financings. And there are some of these terms that are going to be very different from the founder friendly terms that we've been seeing for quite a while now.
Yeah, no, that absolutely makes sense. I mean, I guess two follow-on questions, if I can. One, we always like to understand from your perspective, where are you seeing deals stalling right now, and understanding, as everyone here has already shared, they're taking longer. So patience is definitely a virtue as we go through this environment. But these terms that you're talking about, are they having obviously a real effect in the way that our founders and our companies are thinking about how they enter into it and where the stalling may be occurring? And then secondarily, haven't explicitly called out debt, but are you seeing any major changes yet in the way that the debt terms are being structured, and what the implications or expectations could be as to how it sits alongside, more of the traditional venture equity space?
SC was nodding. Did you want to go for it?
Sure. I mean, I can tell you what we tell our portfolio companies, which is, if you have access to venture debt and line of credit, definitely go for it, because that will, further extend your runway. We also ask them to consider inside rounds should they, need to raise money, just because it's going to be a time of, good opportunities to show support for the existing investors. I do want to say, because to your point, Nikolai, this all feels a lot of doom and gloom, but these are the times where you can find amazing opportunities to create value as an entrepreneur. And so, especially at the early stages, whether you have already received a round of funding or not, I would say take this as an opportunity to maybe adjust your business focus to be about like providing efficiencies to your customers, and that will really pay off for you in the long term.
Yeah. Beautiful advice. The value of every dollar counts. We always know that, but I think now more than ever, just appreciating how much is going into it for our founders, for our investors that are in this space, makes you want to do even more with the dollars that you have access to, for sure. Sarah, anything that you would add as far as like how you're thinking about bringing in supplemental capital to your portfolio companies, or even how you're coaching entrepreneurs as they're coming in pitching you to think about, what other creative funding moments can we pull on in a time like this?
Yeah, I would echo a lot of what Essie said, and especially just around the insider-led rounds, especially because you've been working with these founders for so long and you have that personal relationship. I would really lean back on that and focus on that as an alternative I think, source of funding, especially if there's not as much interest from new investors.
Yeah, yeah. All great and fabulous advice for our entrepreneurs who are a little bit ahead on the journey. I'm going to take just a moment to be selfish to our entrepreneurs who are sitting there going, oh, I'm trying to raise my first round right now. Is this the time to do it? I'd love to invite Sarah and Esty to spend just a couple of moments thinking about the advice that you give to founders who don't have the initial connections. How do they start the fundraising strategy? What's the guidance that you give them? Because it's not about access to meetings. Usually you can probably get there. I think it's about finding the right fit. And I know both of your firms care so much about finding that fit. So how do you invite entrepreneurs to think about finding a fit for themselves, trying to raise that first round of institutional capital? Sarah, maybe I'll start with you, and then Esty, I'd love to invite you to sort of share your perspectives too.
Yeah, I think what is most important to the investor, at least, I think, is tailored and customized outreach. It's very important to understand what the core investing principle is of that venture firm. Is it, a focus on people, experienced teams? Is it a product-focused VC? Or maybe they lean towards impact. And then I think tailoring that message to them when you're trying to outreach to. And especially, I think, if it's someone that you really, truly care about connecting with, if you have any sort of, soft connections or can get intros, that is most effective. And then aside from that, I think a lot of like the fundamentals in terms of what a business is executing on, getting, to certain growth metrics or demonstrating that customer love that Esty was talking about, I think those are all very important for us to see.
Lovely. Thank you so much, Sarah. Esty, you've been on both sides of the journey. How do you encourage founders to think about this?
Well, and look, I know fundraising is incredibly hard. So I want to double click on what Sarah said, which is how you get access to the right investors is often, by referrals. So there's, and especially for finding that right fit. So I would say there's like three types of introductions that you want as an entrepreneur. The first one is introduction by an investor who has invested in you and is introducing you to another investor. It will be something like, I love this company. I'm putting more money into it. I want you to come into this deal. It's a good deal. That's what this intro looks like. The second intro is from somebody who does not invest ever and is a subject matter expert or an industry expert in the business you're building. And they're going to reach out to an investor and say, I'm not an investor, so that judgment call is up to you. But for what they're doing based on my expertise, they have something good going. And then the third kind of intro you want is from another entrepreneur who has received money from an investor and is introducing you to that investor. And it sounds like, you backed me a couple of years ago. Now I want to introduce you to this person because I think they're like me. So what it means is things that you do not want are introductions from an investor who has not invested in you. Because the way it sounds is, hey, I'm not investing in this company, but I really think you should. It's just not going to work, right? It's a good mismatch. So that's I think a great way to Nicolas and Sarah's point to find great fits as investor with really strong referral introductions.
I love that. That's super tactical and practical advice, thinking of the buckets. And it also makes it a little more accessible for entrepreneurs who worry, I don't know tons of investors. That's okay. You just gave them gold as to how to think about buffering up their odds in different ways. So that's just fantastic. Thank you. We always get a ton of questions. And I know this one may feel a little wrong time, wrong place to ask this, but rightfully so. Entrepreneurs are building companies. These are, in many ways, their babies, as we often think of it. And valuation is a worry. Valuation is a huge worry. How much should I be thinking about giving up? There were early comments in the thread way today of like that being top of mind. It always is, even in downturns. That's no different. How do you? I want to take it from the investor lens, and then Craig, I'd love to even double down on your lens because you're as much counsel and coach to so many great entrepreneurs out there as they worry about this battle and this very real struggle. What should the conversation look like maybe internally when we think about valuation, if it's not like that highly competitive deal where and maybe even if it is a highly competitive deal, what is the right mentality to enter into, the right mindset to enter into when it comes to valuation considerations? Sarah, I'm going to put you on the spot. I know it's a tough question, but would love to get your thoughts on the valuation. And then SC and Craig, I'm going to flip over to both of you for this one.
Yeah, I think first of all, if there's any sort of comps in terms of, who else out there has raised and is doing something similar to what you are doing, that's like the first helpful benchmarking point. And I think ultimately for investors, what we're looking for, I would say the majority of investors want to see some sort of public exit or IPO. And so what that means is that you should be benchmarking yourself to how public comps are doing. And so if it's someone else if you're building a fintech company and someone else is doing something in the same vertical, how are other people trading? Is that off of revenue? Is that off of EBITDA? Is that off of, like a gross number? And so I think having that in mind and not expecting that every sort of valuation will be the same, because software companies trade differently from fintech companies, I think goes a long way, especially when you're chatting with investors and showing that you're knowledgeable about what you want and are asking for as a founder.
Yeah, that's so good. And I think also you're alluding to a lot of the recognition that this is a journey. There's multiple stages, there's multiple rounds. So maybe also don't get too hung up in the one in the moment, because it's about getting to the next moment rather than worrying about the end sight just yet. So super helpful. SC, what are your thoughts around this, and how do you help founders think through this tough one?
Yes. So I will maybe give some stats that help me think through that. At most point in time, there's about 100,000 venture funded companies, and about 5,000 of them are going to go through an acquisition or an exit rather. And out of these 5,000, between 500 and 1,000 will go public, IPO, SPAC, what have you. So that these are already helpful maths, right? You can raise a ton of money and it's not going to go anywhere, and you won't make any money as an entrepreneur. So, but if you start with the end in mind, so to Sarah's point, right? If I'm going to go public, and that's my ambition, I'm, in the 500 or 1,000 companies, then I'm going to have to compare myself to a public company. So if I come to an investor and I say, hey, in my industry, the multiple in public market is whatever, 10x, but I'm asking you for 20x because there's no good reason, right? Because eventually you're going to have to come down to meet that public multiple. And we all, Craig was sharing, in a downturn, entrepreneurs get hurt first. Investors have terms to protect themselves. So that, if you're targeting that IPO, then definitely use comps that are IPO. If you're targeting M&A, then what I encourage you to do is, first of all, some facts about M&A. 95% of acquisitions are under $100 million. And in the recent cycle, it increased a little bit, so maybe 200, but still, it's not those billion-dollar exits that we read about in, TechCrunch. And so if you kind of, again, work backward, you say, hey, I'm going to be acquired for $200 million. And in order to do that, like the companies that get acquired at $200 million, they have X much in revenue. Well, how much money do I need to raise in order to get to X much in revenue? And then you can work the math backward so that you always keep your end goal in mind, and you will be, happy, successful, wealthy serial entrepreneur, as opposed to, the folks who are not in the companies that end up exiting. It can be really hard for them to then start again, and they start again from the very same point, right? As opposed to, I exited my company. It might have been my first one. It might not have been the amazing numbers we read about in the press, but now I'm on a completely different highway because I'm a successful serial entrepreneur when I start my next company. So valuation, my 2 cents is don't be too picky about the valuation in general.
Yeah, but the valuation alignment to sort of the founder expectations of exit, super helpful strategy. Again, I think that's an internal conversation that has to happen before being able to sort of go into that meeting with confidence around what your valuation should or should not be. So good. Craig, again, to sort of point to you, you've got so much experience and obviously now thinking through the last downturns or market cycles. How do you coach entrepreneurs to think about, this moment in time versus the long game that they're really on and in the marathon of entrepreneurship, in valuation conversations at least?
Yeah, I mean, the interesting thing about valuation, and I think SC's really hitting on it, is that it's not as important as people think it is. And what really is important, and this was like, I saw a question earlier in the chat about, do founders have to give up 40% of the company in the first financing? It really is in the first round in particular about that dilution. And every round is about the dilution. But in the first round, of course, when the company's being valued for the first time, typically there's zero revenue or very little revenue. It's certainly not profitable. So the company's not being priced on any public type multiples in the earliest stage financings. It really is kind of a backwards math. It's all about the amount of dilution that the founders are going to be taking. So typically the way that you end up with a valuation on the first equity financing is you look at the amount of money that the company wants to raise, you look at how much dilution the founders are willing to take, how much ownership they're willing to give to the investors, and that backwards math leads you to what the valuation is to get to that desired percentage ownership for that desired amount of money. And so that means that if valuations start declining for the earliest stage financings, companies, and we talked about this earlier, may be inclined to raise less money, but people really should be focused on the percentage ownership and also the voting rights, and what the impact is. At what point are you giving up full control of your company to the investors in your company? But in answering that question earlier that I saw in the chat about, do you have to give up 40% of the company? You don't necessarily have to give up 40% of the company in the first round of equity investment, but somewhere in the range of 20% to 40% ownership for the venture investors in the first round is pretty typical. And where you fall in that range depends on how far along you are, how much money you want to raise, and frankly, how much equity you're willing to give up. Yeah. And the market's gonna dictate that, because it is surprising how even though the VCs aren't talking to each other about a deal, if you've got competition for a deal, you're going to be in a position to negotiate better terms. And if there's no competition, if you've got only one buyer, and you got to, then you're down to a question of, do I take this money or do I, shut down the company and walk away, or bootstrap and find a way to make the company successful without raising money at that particular point in time.
That's right. So good. Okay. Well, I have a ton of amazing questions that have popped in. So we're going to do like fire lightning round here in a second. If anyone wants to try to squeeze in one more, now would be the time, because I'm going to be a pain and launch one more poll. But the reason that I need to launch this poll, my friends, is every program that the center builds is based on what you need us to be building. So this is my ask of you. Could you just let us know what is your biggest barriers and struggles right now? Our program team will go ahead and reference this, and they'll sprint cycle out in the next 6 to 8 weeks the programs, the content, the classes that we're offering, all for free for you as always. But this will help us figure out what the calibration needs to look like sort of in the August, September timeline. So thank you for sharing that. Really appreciate you. Looking like, not surprisingly, a lot of finance, sales, and marketing issues, and surviving and hanging in there. We get you. We got it. Okay, thanks for that. So lightning round questions. First and foremost, kind of coming in, a lot of additional asks around valuation. SC, this one I'm going to direct directly to you because it was asked of you. Multiples. You talk about multiples on revenue. Is there a general rule of thumb that you think of when it comes to what are the multiples that people should be looking for?
Yeah, so we look at revenue, like GAAP revenue multiples. We don't look at ARR multiples or booking multiples. We want to base that on GAAP revenue. And then in a typical SaaS business, it will be like between 10, maybe sometimes 20x to the revenue. That is sort of a fair valuation. In different industries, like in media, e-commerce, the multiples tend to be like 3 to 6 times the revenue. And then in finance, like fintech, it tends to be a little bit higher, 20, maybe to 30x the revenue. And these are relatively conservative, but again, they're what's going to get you to all the way to the end without having to have these, unfavorable terms.
Yeah. So good. Okay, Craig, I'm going to throw this one to you. Question coming in on pre-seed, or our much beloved, and I kind of come from this space a little bit, the angel world. Are you hearing or seeing any impact on what the numbers are looking like for the angel landscape right now?
My personal experience, and again, we'll have the data in July for how this quarter looked, is that it's tough out there, that a lot of angel investors who typically do the earliest stage investing are investing money that they're recycling from wins that they have had either in their own companies where they got liquidity, or they're very active investors in other companies. They've had a lot of great liquidity events for companies they've invested in, and they have dollars that they want to reinvest. And that, of course, is a challenge right now with the public market so difficult. And M&A, still active, but M&A deals not as frequent as they were, and valuations certainly much, much lower than they were just 3, 4, 5 months ago. So I think the angel market is not impossible, but it's more challenging. I think the good news is that in the last 5 to 10 years, a lot more super early stage venture funds have been created, smaller venture funds, micro VCs that have taken the place of traditional individual angel investors in a lot of cases. And a lot of these funds have a lot of capital, and they're in the business of investing early stage, and they want to keep doing deals. So we are seeing a lot of really good activity from those micro VC funds. Definitely more difficult with the angels.
Yeah. Okay. On the flip side, we talked a little bit about M&A, just staying with you for a second. A lot of curiosity around M&A. Are you seeing any big changes that are happening there as far as deal length of times, numbers, and then any expectation based on past cycles of what we might be expecting to see from a volume of M&A increase or not in this coming quarter or two?
Definitely similar with venture rounds. Deals are slower, longer diligence periods, and valuations dropping, including during the negotiation period. And, with the VC financing, it's interesting. I've worked on probably 2,000-3,000 venture deals in my career. I have seen a VC walk away from a term sheet maybe 3 or 4 times in all of those deals. When VCs sign a term sheet, that deal almost always gets done. With M&A, even in a good market, you've got maybe a 1/3 chance that the deal will end up closing based on a letter of intent. And I think that's even more challenging in this current market, where there's a lot of uncertainty about where valuations are settling. It appears we're not at the bottom yet. I think a lot of people are concerned we're not at the bottom yet. And that leads a lot of deals to get renegotiated during the course, or buyers just walking away because they're not comfortable with the valuation. So I think it is challenging now.
All right, I'm gonna squeeze one extra one in, even though I know we're against the clock, and it's to Sarah and to SC, because it's such a good one. Founder needs to close on a term sheet, getting a lot of good signals. I got a lot of interest. Cannot get that lead to convert. Any ideas on what you can do of encouragement to move from an interest to a conversion to actually getting a term sheet? What advice do you give for founders that get all the right signals but still no term sheet yet?
I can just quickly take this one. I think the most important thing for VCs is signaling, getting that kind of positive signaling from other founders, other references or VCs is extremely helpful.
There you go, back to that. And I'm sure SC is going to double down on the customer, like make the customers be your biggest champions out there, probably a bit. Anything else you'd add, SC?
I think it's just staying with it. If you want it, it's going to happen. So just stick with it.
And I could not ask for better words to end on. Stay with it. Stick with it, my friends. We know this time is a tough one. You're making the right strides. You're getting the right support. Continue to ask for help. Ask from one another. As your peers are out in market too. They're an incredible source of knowledge and learning. So don't forget about them. Thank you so much to our incredible panel. Craig, SC, Sarah, deeply appreciate your time and support in this. It's been a pleasure. And to all of our entrepreneurs for joining. We really appreciate you. We know how much you've got going on and you found time to be here today. Stay tuned for more programs, more feedback, more follow-up from us. A copy of this recording will be in your inboxes shortly. And in the meantime, please take a moment to fill out that survey that you see in the link and let us know what more we can be doing in support of you. Thanks to everyone, and we will see you soon. Take care. Hang in there. Bye.
Thanks.